HMOs are often marketed as the best property investment you can do if you're looking for cash flow. And as a cash flow play, they can be a good addition to a diversified portfolio, but they're not always what they're cracked up to be. In this video, I'll talk you through why we have no plans to buy any more HMOs within our portfolio and exactly why that is. We'll look at each risk you need to be aware of in 2025 if you're considering buying an HMO. If you're new here, my name's James. I'm the co-founder and managing director of a property investment consultancy called Freighter Property Partners, where we help investors build and grow their portfolios in the long term. But this channel is all about your education. If you like the video, don't forget to hit that like button and subscribe to the channel, but let's get started. Firstly, I completely understand the appeal of an HMO property. They offer high rental yields and give you the opportunity to have a strong return on investment when you're looking at rental profit or a cash flow play as part of your portfolio. And to be honest, this is what attracts most property investors who have bought HMOs in the past to HMOs. The likelihood is you'll have a good rental ROI on the property, which means that rather than just earning £300, £400 a month from a buy-to-let, you can earn up to £1,000 or £2,000 a month just from one property. The first difficulty I see with HMOs in the current market is the lack of appreciation in these assets. Obviously, the rental return can be strong on these types of properties, but that's almost as good as it gets. Because the resale market of HMOs is significantly smaller than the overall residential market, because you're only going to sell an HMO to an investor that is looking for an HMO property, that market size is significantly lower, which means the increase in value on those is relatively limited. Compare this with a buy-to-let property. You can sell buy-to-lets to other investors as well as normal home buyers. The growth of the property is likely to be significantly more and grow in line with the wider market, whereas HMOs often don't grow in as much value. This means that although your rental return is strong at first, this is actually getting worse over time. And if you're holding an HMO for 10, 15 or 20 years, inflation is eating away at your investment over time. This is why when people ask me about HMOs and have asked me in the past about HMOs, I often say they can be good as part of a diversified portfolio, but you need another part of that portfolio where you've got assets growing in value that you have leveraged and give you the opportunity to continue to build your wealth over time while getting that income from a HMO. The second reason I wouldn't look at a HMO in the current market is because of the valuation methods. One of the big things people look at when investing in this asset class is converting a property to an HMO and then managing to get a commercial valuation on that property so they can release as much equity or as much cash out of that property as they can do to then go do it again and scale the portfolio. Having said that, it's not as straightforward as it might sound. The reason for this is getting a commercial valuation on the property is a bit of a lottery. You don't know who's going to come out and value that property. They could give it a standard bricks and mortar valuation or give it a commercial valuation. This commercial valuation essentially sees the property as a commercial asset rather than a residential property, which essentially can value it at a significantly higher value than what it's actually worth as a property. This can be why you'll see one property next to another which is £100,000 more valuable, even though it's very much the same property. One of the problems with this is you'll often have to buy a property in cash, do all of the work on the property, and essentially cross your fingers to hope that you get a commercial valuation on that property. There's absolutely no guarantee that you're going to get that, and it might just depend on the surveyor on the day and whether they feel that it's worth that money. And even if you do get a commercial valuation on that asset will be valued significantly higher than the other properties on that street. And essentially, it's not necessarily a true reflection on that property. It's really a way to scale a portfolio and take advantage of valuations. This again may make it difficult to resell in the future if you ever want to sell it at that higher valuation, because you've got a small pool of investors that are willing to buy a HMO and an even smaller pool of people that will be willing to buy it in cash and risk the valuation problems. Don't get me wrong, lots of people have managed to do it in the last few years, but it is becoming more and more apparent that it's more and more difficult to get that commercial valuation out the back end. And to be honest, it's not really a true reflection on the value of that property. The third reason why I wouldn't consider a HMO in the current market is because of the hidden costs, the void periods, and the management involved. When I speak to investors at my business, Freighter Property Partners, we often talk about HMOs as a marketer's dream. Whoever's selling or marketing the property can market really strong, high-level numbers, but when you actually dig into the detail, that return is significantly lower. The first thing you need to be aware of is the void periods. Because you'll be renting the property out on a room-by-room basis, you'll often have people that move in for a number of weeks or a number of months and then move out. And when that specific room is empty, you then obviously have your void periods when you're not making any money in that particular room. Obviously, if you're an expert within HMOs or you're really good at managing that type of property, you should be able to find similar tenants relatively quickly, but it's obviously not a foregone conclusion. In the same vein, you're going to have a significantly higher tenant turnover. Again, because you're renting the room out on a room by room basis, 1 month you might have one tenant move out, 2 months later you might have a different tenant. This means that each time you have a void period or you have a tenant that leaves your property, you're going to have to remarket and have additional costs associated with finding new tenants. This is obviously going to eat into your profit and means that your high level 15 or 18% yield might actually be significantly lower than that and can often be 8, 7 or even 6% net. What you might do instead is choose to get a management company who specialises within HMOs to do it all for you, so you don't have to deal with the stress or anything like that. And this comes with additional costs as well. If you rent a normal buy-to-let property out, the likelihood is you'll pay somewhere in the region of 10% plus VAT to the management company. But for the more intensive HMOs, this management costs are going to be significantly more, which further eat into your monthly rental profit. The good news for a HMO investor is obviously we have a significant housing shortage in the country. So there are lots of people that do want to rent good quality accommodation across the country, but you need to be providing good quality homes in order for people to actually want to rent that property. You need to look at this like you're running a business rather than you own a property that you're renting out. You need to be providing a really high quality service to the people in your HMO to make sure that you're going to have lower void periods as well as lower tenant turnover, and fingers crossed, lower maintenance costs. But as I mentioned, there's obviously no guarantee on that. With more tenants, more tenant turnover, the likelihood is more things could go wrong, which means that's going to come out of your pocket as well. The reason I say this is because we've had it ourselves. A few years ago, we bought a HMO in the Midlands. That property seemed like the return would be really strong, but once you calculated your void periods, your management, your maintenance, and a few things that went wrong throughout that property, that actually only gave us a 6 or 7% yield and saw very minimal growth in that time frame. What I then did is look back to work out what we would have got if we actually used that money to buy a standard buy-to-let. And to be honest, once you calculated the growth with the rental profit, the buy-to-let blew the HMO out of the water. This means if we put that money into something that was going to give us less stress and less effort, we would have made more money. So in my head, it's a bit of a no-brainer. And this brings me on to the fourth point of why I would not buy a HMO moving forward, and that is that the time intensiveness does not meet my current lifestyle. For me right now, my priority is growing my business, Freighter Property Partners. This is where we help investors just like you build and scale their long-term portfolios to achieve their goals. I don't have the time to go and manage HMOs or deal with lots of tenant turnover and issues going on with those properties. And to be honest, I don't want to do it either. A lot of our clients that we support are in a very similar position to us. They're earning their money through their day job or running their own business, and property is a way of building their wealth and protecting their wealth in the long term that doesn't give them a second job and give them lots of headaches. Property is never going to be completely hands-off, but if we can set it up in a way that you don't have to spend lots of time managing the property or finding those properties, the likelihood is you're going to continue to invest in the long term and achieve your long-term goals. The final reason why I wouldn't consider buying an HMO in 2025 is because of the blanket introduction of Article 4, with councils taking back control. If you don't know what Article 4 is essentially where councils are taking back control of developments in the local area, which means that you can't just convert a property to a HMO without planning permission. Previously, you would have been able to do that on a small HMO under a permitted development, but Article 4 essentially means that you're not able to do it under a permitted development if you're within one of these Article 4 regions. It's essentially stopping investors just buying a property and converting it into a HMO without getting planning permission. The councils will want to do this because they don't just want specific areas having loads of HMOs, they still want these locations to have communities and have properties where people are living in the long term. There has in the past also been links with HMOs and antisocial behaviour. Obviously, not all HMOs are linked with antisocial behaviour, but it can cause other issues like parking problems or noise complaints. And the main reason is there's just more people within these properties. So councils will want to make sure and police that there's not too many HMOs in one specific concentrated area. This blanket introduction of Article 4 across the country essentially makes it more difficult for HMO investors. It's obviously more difficult, but as well as that, more expensive to set up a new HMO, and you're essentially at the mercy of the local council giving you permission. And if you ever had any experience working with local councils or government, you need to know that nothing is guaranteed and you need to be aware of that risk. So to conclude, there's a number of reasons why I would not be considering buying an HMO in the current market. These include the limited growth that you're likely to get on an HMO property, the valuation limitations that you can have if you're trying to get a commercial valuation on that property, the hidden costs involved in managing the property, the maintenance and the tenant turnover, the time it takes to manage these properties, and the fact that you can get significantly better investments in the long term by going for some more hands-off strategies. And finally, the blanket coverage of Article 4 has made converting properties into HMOs more and more difficult, and it's not something that I want to do personally. If you're like me and want to use property to build your wealth in the long term, but time is your biggest asset, then HMOs are not the way to go. You should be spending your time on your day job, running your business, or spending time with your family, and use property in the background to build and protect your wealth in the long term. Once we've leveraged our investments and giving property the time it needs to grow in value, to recycle equity and scale the portfolio, we'll get to our long-term goals and give ourselves the true freedom that property can provide. Having said all that, your situation might be quite different to mine, and you might have the time and the energy to put into HMOs and this type of investment. And if that's the case, then absolutely fair enough. What you can do is use this video to understand your risks and still go down that route if you have the time, the energy, and want to do it. But if you are like me, then use your job or your business as your primary source of income and invest in property in the background. That is it for today's video, so I hope you found it useful, and I'll see you soon.